Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here deep into March 23rd, 2023, Market Carver. We've got three topics for you this week, following last week's deep dive into the banking issue. We're going to take a look into market activity and kind of update you on where we've seen things go year to date. In a few things, we're going to take a look at the bounce in tech stocks that we've seen so far for the year. We're going to take a look at bond market and where it is in terms of its attempt to recover a prior high, because we've seen a pretty strong bounce in bonds for the year. And then lastly, Andrew's going to cover the trendless market that we have seen. Kind of weird to say that, right? We think of the market as having been trending down, but when you take a look at the actual data here, we've been in a very interesting range that he'll dive into. So we'll take a start with the year-to-date rebound in tech stocks. So if you take a look at the indices, they've actually done decently for the first quarter here in 2023. But if you take a look under that, it's been a very small group of stocks that have led the way, specifically technology stocks. And if you go even beneath that is the growthiest of those tech names, which has had the strongest run. Meanwhile, a lot of other sectors remain underwater, or somewhat of a reversal of what we saw last year where tech stocks really drug us down. Now, some important context for that. Number one, I think you'll really see that really surge in tech stocks misleading the performance of the overall index, much like we saw in pieces of the biggest parts of the boom in 2020. But also, we'd point you that we are still viewing this rebound in technology stocks with just a little bit of skepticism. And we say that because we think this is just a couple of months into the year, and it's very common after you see an extraordinary decline for there to be periods where there is extraordinary rebounds in that sector. We might very well be in the midst of one of those. In fact, if you go back over the past 100 years, we've had about 10 major bubbles. You had stocks back in the 1920s. You had stocks again, U.S. largest caps in the 1960s, commodities in the 70s. Japanese stocks in the 80s. You had dot-com stocks in the late 90s. I'm probably missing a few in there along the way. But the tech stocks really late in through the COVID period, really at least a niche of them entered what we would clearly classify as a bubble. Now, typically, if you take a look at those 10, on average, there were 4 periods where there were major 20% runs, a minimum of 20%. So that's why we have some skepticism here. It's natural for things that are on the way out of a bubble to have periods where they shine, and still think we might be one of those in tech. So we don't get locked in and certainly glued to this. There were pieces of the tech sector, I think it would be a reach to call them a bubble, and we own a couple of those names. So we don't want to shun the entire sector, but we're not quite there to say technology is on its way back. This is just a natural part of market flows. Moving now to bonds, really the way we as investors and humans as investors more specifically often review our investment account is where is it related to its high? We don't necessarily remember where it was, say, before there was a rally or where it was even maybe the start of the year, but we certainly know where it was at the highest value. So this is a look at just the bond piece and how extraordinary this period is. Of course, we didn't have any shortage of covering this in 2022, just how severe this bond market is. And we have seen an extraordinary rally in bonds, but this just shows you the pain that can be had from losses in that period. So this is a chart of the Bloomberg's aggregate bond index going back into the 70s. So there's not a ton of history here for bond markets outside of U.S. governments, but this is one of the first comprehensive and aggregate looks at it. So there's a 17.2% decline in that index, but we have now gone 31 months since recovering that prior high. And that's really one of the main appeals from bonds is that when you do have a drawdown because there is a termination date, there is a period with which you get your money back, there's usually not a long gap before you recover that prior high. But now we are double what was the prior mark on history, going from 16 to now 32 months and really nowhere near recovering that prior high. Now, I will say this chart is about a week or two, I'd say, past covering this entire bond rally that we saw last week following the Silicon Valley Bank collapse. If you added that in, it's remarkable. I think we're maybe at 12 or 13%. Still down for the year. That's just how painful it is when you have a decline of this magnitude and how long it takes to get that back. Now, the good news, if you take a look at the bonds that we own and really the shifting that we have done, I know sometimes you guys say, boy, I'm getting a lot of emails from trades you've made and seeing a lot of new tickers into the portfolio. The reasons why on the bond side is really trying to be in the right areas. We have to do a lot of bobbing and weaving. And if you look at our withholding, we're much closer to recovering that prior high than the overall market. But just wanted to give you an update there. And Andrew, we'll pass it over to you to hit the trend of the market and really how you're looking at this environment from a technical perspective.
Thanks, Adam. So we often will I'll share different charts in our allocation meeting and bring a lot on here to the market Carver, looking at the market from many different angles. Some look a little bit more congested than others. But often it's a good idea just to strip everything down and just look at the broad market. Traditionally, we always talk about the S&P 500 by itself. And where do we really stand within the current trend or lack thereof, which we're going to talk about today, of the price for the market. And so here's just a very simple go basically since 2022, the S&P 500. And what's interesting is we always get all these breaking news headlines, all these things that can distract us and think that the market maybe is doing something that it's not. Like we talked about all last week about Silicon Valley Bank going under. There's been other news about other banks and different things that different governments across the world are trying to do. We have the Fed, we have inflation, we have wars, we have all these different things that distract us and maybe pull our attention away. But when we look at the actual market, and this is what I shared in our allocation meeting on Monday, was the S&P 500 is essentially at the same level that it was 43 weeks ago. In really shorter term, it's really the same level it was less than 90 days ago. It's been in this kind of a very wide range, but it really has been kind of a trendless market for several weeks, and we could almost say several months if you wanted to kind of relax the requirements there. But essentially, for the last 90 days, the market hasn't really gone anywhere. And in the allocation meeting, we did a much deeper dive looking at historical examples of this. It's not that unique. We've seen this happen many times in the market where we see these consolidations. Sometimes they're much tighter. In 2015, it was basically a 4% range where the market really didn't move a lot. Here we have more of a 20% range going back, including the big gyrations last summer. But the main reason of discussing this and saying that we're kind of in this trendless market is I liken it to driving through the fog. You've probably all, especially those of you watching from Indiana, you've had those early mornings where the streets are packed with fog and it can be a little harder to see. Traditionally, what you're not going to do is turn around and go home or pull off the side of the road because it's foggy. What will you do? You're most likely going to slow down. And that's how we're approaching this market. We're kind of in a period of fog. We don't know which direction the market's going to go next. Where will the next move be? We're in this consolidation, so we're just slowing down. Our risk parameter models on neutral. We're still keeping our core asset allocation, but we're not pushing the gas too hard going up. And we're also not wanting to get overly defensive, thinking that we're going to see another big decline. We're waiting for the data to tell us to give us the best insight of what the market likely or potentially could do next. But right now, we're just kind of in that period of fogginess where the trend is kind of dissipated and we're just waiting for that next move. And so we begin just slowing down. And that's important that we get questions. Should we go to cash? Should we go to bonds? Should we go to all equity? All just being all stocks. And right now our view is, and every person's different, but right now we don't want to have too much an emotional reaction to either what happened last year or what happened, what kind of the headlines in the news right now. We just want to take it kind of day by day, week by week, month by month, year by year, and make proper decisions based off the data. And so right now, I think it's really interesting to recognize that the market really has kind of been in this standstill for the last several weeks, doing a pretty good job at digesting a lot of these big headlines that we've had, which I think is a good thing. But right now, we're kind of in this consolidation. We're just waiting to see where the market will go to next and focusing on the data that we have to give us that insight.
All right. Well said, Andrew. And we'll be ready, as you said, to join that trend whenever it does emerge, and we'll be patient until then. Certainly remember all those trendless markets, and sometimes that can set in and it can feel like forever. And we're prepared for it to take a long time. It's just the nature of the business that we're in. So with that, I do thank you all for giving us your time this week. As always, last reminder here to give us a call to come see us, 800-928-4001. We'd be happy to sit down and see if there's any way we could work together. That's if we work with you currently, or we haven't had the pleasure meeting you yet. So everyone, please have a great week.